reasons to be cheerful in the first flush. Pre-tax profits doing very well, special dividend, and maybe you'll speed the buybacks. But I just wonder what level of caution you have, because I look at the net interest income guidance, it's at 36 billion. That's lighter than the fourth quarter on an annualized basis. How cautious are you?
So, Manus, thank you for having me. It's good to be here. And yes, I'm pleased with performance in 2022. We delivered an increase in adjusted pre-tax profits of 17%, taking us to 24 billion. We delivered a ROTE of 9.9% after significant items and the loss on sale of France. But before that significant item, it was an 11.6% return on tangible equity, which puts us in a good position to deliver the 12% plus return on tangible equity in 2023. But Manus, if you just allow me a few more comments, I'd also like to reflect on the change that's taken place over the past 3 years. If you go back 3 years ago, as you'll know, we were very dependent on profit generation coming from two principal markets, Hong Kong and the UK, with a strong international banking franchise overlaying that with transaction banking and international wholesale banking. What I'm really pleased of 3 years later is a radical change in the profit generation by geography. The Middle East alone last year generated 1.8 billion of adjusted pre-tax profits. Our troubled market in Europe 3 years ago produced an adjusted pre-tax profit of $2 billion. Our US business, again troubled 3 years ago, produced an adjusted pre-tax profit of 1 billion. And even within Asia, we got good diversification. Outside of Hong Kong and China, we generated more than $4 billion of adjusted pre-tax profit in 2022. So that gives me a solid base of geographic profit generation, supported and overlaid with a strong international banking franchise and a market-leading transaction banking franchise. So that gives me confidence in our 2023 forecast. Now, to come to your point on net interest margin, our guidance on NII is 36 billion plus, in excess of 36 billion. We believe that we still have upside. Our NII in 2022 was 32.5 billion. We're guiding to in excess of 36 billion in 2023, so good growth. There are some uncertainties on the horizon, but we're still positive. We know where consensus is at the moment, and we think consensus is in a reasonable position. So we're not looking to change guidance on NII, and I think we're pretty confident we have a good prospect of delivering our return next year.
So that's a fairly solid footing and a guidance, as you say, in excess of the 36. Look, you're in the sweet spot for payout. You've told us a special dividend this morning. What I want to get a sense is, will all the proceeds from the sale of Canada go to a buyback? What does it take to assure the move to a buyback in May, Noel?
Well, listen, we first of all have to close that transaction, and we're aiming to close that by the end of this year. What we've signaled today is our first and priority use of some of those buyback proceeds will be a 21-cent special dividend. We think it's important to make that the first use. Thereafter, as we close the transaction, we'll make a decision of how much additional distribution we do via buyback and how much we retain for internal use. We're not making that determination at this point in time. We'll make that determination on closure. But I think I'd go beyond just the special dividend and the use of Canada proceeds. What I think we've signaled in these results is good profit generation. A 50% payout ratio gives us good return to shareholders via dividends. It gives us also then the ability to use the remaining 50% for growth and for buybacks. And I think that's the difference today, a radical difference to 3 years ago, where we were over-distributing, one could argue, towards dividends. We were sometimes in a payout ratio of 70, 80, 90%.
Where is it reasonable for the market? I was with CEO Ralph Hammers a few weeks ago. He's paying out 5 billion. I was with Andy Halford at Standard Chartered last week. He's paying out 1 billion. He's got a whole set of other issues to deal with, not like you. What is reasonable in the scale of buyback that the market can assume, Noel, if and when you take it and present it later this year?
We're not guiding at the moment on the quantum of buybacks. We'll deliver that result on the quantum of buybacks later. What we have announced today is that The process for considering a buyback, we're accelerating from the second half of the year to be a process that completes at or around Q1 results. So we're pulling that forward by around about 6 months. I think that's an indication of our confidence in the profit generation capability of the bank.
When I look at the lines on credit losses in China, $600 million, but you say the headwinds will subside, and you use words like normalize. Is this peak credit losses in China, Noel? And when does that normalization arrive? Can I push aside a complete implosion in China now off your radar?
Well, I think we're comfortable with where we struck the provisions on the 31st of December. And since the 31st of December, one could argue the environment in China generally for its economy and commercial real estate has improved with some of the policy announcements that were made in early January. The supply side has benefited by the provision of more liquidity by the Chinese banks and the Chinese government, the relaxation of some of the regulatory constraints that were on the sector, plus some of that extra liquidity has been made available for the offshore debt as well. And that's an important move that took place in early January, and clearly we welcome that. So the sentiment has improved in Q1 in January relative to where we were in Q4. I think there's still a lot of work to do on commercial real estate in China, but we're comfortable with our provisions at the end of December.